Howdy folks, welcome into the reaction channel. I got 4 pieces for you guys here today, 4 videos up for me to react to. First one up here, Kathy Wood put out this video 2 days ago. I want to react to it. A message from ARK CIO Kathy Wood. I think it should be an interesting one to react to. The comments insanely negative. The reason for posting this video is that she attempts to stop outflows of her funds. Not more than that, she's a salesperson trying to keep the fees. If you invested in her main fund 5 years ago, you're down 20% on your original investment. She's a very good marketer and PR guru, that's for sure, but it's just very, very negative, right? And the reason being is, if you look at a 5-year return, ARK has lost money. Like, if you invest in ARK over the last 5 years, you're down 8% versus S&P 500's up 83% versus the NASDAQ's up 142%. So it's a really bad look, obviously, for Kathy Wood that her fund has done this poorly over the past 5 years. And so I want to react to that, kind of give my opinion and perspectives there. Then we'll react to this one. Enough data out there. Earnings to point toward consumer slowing, says Adam Pitapaka. So looking forward to reacting to that one. I have no confidence the unemployment rate will stay where it is. I want to listen to that gentleman. And then last one up here, Tom Lee. The worst of the selling pressure is behind us, says Tom Lee. So looking very forward to reacting to that one. Appreciate y'all joining me as always. Thank you so much for being here. Thank you for being subscribed to the channel. If you're looking to apply, join my private group, my private wealth group, my private stock group, that'll be pinned comment down there, as well as getting access to 1000xstocks.com. Let's go ahead and jump into these.
This is a very active time in the market, I don't have to tell you. But this week, the VIX...
I feel like it's a great time in the market, just to be quite frank. Like, I feel like it's tremendous. I'm loving this market.
Crossed 60.
Like, I'm making a ton of money on many of my biggest positions. Then the positions that I want to go down in the short term because I'm buying those, it's going down. Like, this is... Honestly, this is one of my favorite markets we've seen in quite some time. Like, this is a beautiful market.
Which is the 4th largest measure of volatility in the market, really in the last 40, 50 years. And I've been around for all of them. So it's 4th after 08, 09, the tech and telecom bubble in 2000, and 1987. Now, what does this mean, this volatility alert? It usually means the market is meeting a cathartic moment, or is in a cathartic moment. And it usually means something is changing. And as you know, we have believed for quite some time that the U.S. economy and maybe the global economy has been going through a rolling recession ever since the Fed started raising interest rates.
So what she says right there, 100%, that is correct. We have been going through a rolling recession, really industry by industry. Different industries have felt it at different times. Like tech, you look at tech, oh my gosh, did they feel it in 2022, right? Look at them really the past year or so, look at their earnings. It's like they're certainly not in a recession anymore. Then you look at a lot of the big consumer brands over the past year. Though those brands were still doing great in 2022, Starbucks, Nike, a lot of those sorts of companies, right? Now look at those companies' earnings recently. Horrible, right? So yeah, 100% she is accurate about we've kind of been through a rolling recession over the last few years.
Well, the other thing that was happening during that time, apparently, was an increase in the carry trade involving borrowing yen, so really shorting yen, and buying dollars and investing them into higher yielding assets than in Japan.
That's just the carry trade she's talking about there.
So playing the spread. The other reason this became a very widespread trade is the yen has been depreciating. So shorting yen meant that the investor or the speculator was benefiting from the yen going down. Well, that changed abruptly this week as the Bank of Japan increased rates more than expected and seemed more determined to continue increasing rates than many people expected. So apparently, lots of margin calls and a sell-off in a lot of assets.
All right, so what she's bringing up here at the beginning, like, these are facts, okay, but at the end of the day, Once again, people are upset, Kathy Wood, for this 5-year performance, right? And it doesn't matter what's going on with the carry trade in Japan. It doesn't matter if volatility is high. It doesn't matter that we've been going through a rolling recession. As an investor, as a stock picker, as somebody that runs money, whether that's your own portfolio or you're investing other people's money through an ETF or a hedge fund or anything like that, right? You have to be investing in great companies that have many bright years ahead regardless of what happens in the economy, right? If I go to buy a stock, I want a type of company that I don't have to worry about in sort of this sort of recession or that sort of recession, right? I want a company that, regardless, their earnings are going to be strong, right? They have true pricing power out there in the market. Like, so all these other things, I just feel like it's facts, sure, but it's a lot of excuses. As a money manager, you got to just, who cares about the carry trade? Who cares about volatility? You should still be performing well despite all that.
And now the VIX has calmed down.
The only way you should be losing a lot of money as a fund manager is if the market is in a full-scale crash, right? And the S&P 500 goes down 20, 30, 40%. Okay, fair play. Like 2022, like if you got hit in 2022, cool. Like everybody got hit in 2022. But this past year or two, you shouldn't have been getting hit. Your returns the last year or two should be phenomenal.
Now, we're not sure if the carry trade has unwound completely. JP Morgan is saying we're halfway there. So perhaps we'll see some more volatility. But I do believe that the Fed now is on high alert because the stock market seemed to be encouraging the Fed to hold tight, higher for longer, make sure that inflation was out of the system. And as you know, we've been saying for quite some time that inflation is unwinding much.
I mean, hold your horses for just a moment, okay? The S&P 500 is only down a few percent from all-time highs. It's not like, I mean, if the market would have crashed Monday, right, and then just kept crashing throughout the week, then that would freak the Fed out. The Fed would start maybe panicking in this situation. August and September seasonally are just horrible months for the market in general, right? Secondly, we're down a few percentage points on the S&P 500. You know, if we're down 15%, okay. Now Fed's like, oh boy, like we got to get rolling here. Let's get these rate cuts through. Like 3, 5, 7% off all-time highs. Come on, man.
Faster than we're seeing in the traditional indexes. Right now, the CPI is at 3.1, but by other metrics, we're seeing prices fall. And we would not be surprised to see prices fall a little more broadly as the consumer weakens. Now, why is the consumer going to weaken or continue weakening? We believe it's because corporations are losing pricing power. And in order to salvage margins, they're going to be doing two things. They will be laying people off, and they will be accelerating moves to increase productivity. So the unemployment rate will go up. That certainly is getting the Fed to change its spots, as we're listening to Chairman Powell. And I think now that household net worth being hurt by the stock market going down is another reason that the Fed...
By the stock market going down? Like, ma'am, hold on, okay? Let's see the year-to-date returns for these guys. Oh my gosh. How is ARK down 18% this year? How? Like, there's no reason you should be down this year. No. But anyways, here's the deal. S&P 500 is up 12.6% this year. Nasdaq's up 11.9%. The general rule for the S&P 500 is you make about 8% a year. We're a little over halfway through the year, right? And we're at a 12% return. This is phenomenal. Like, yeah, if the stock market, if the S&P 500 crashes, then we can talk about household net worth going down. But like the stock market is tremendous. Let's not fool ourselves and act like, oh, the stock market's bad or something like that. Like, come on, man.
Is going to relent.
There is something that's bad this year, but it ain't the stock market.
One last thought here. Interest rates coming down should be very positive for the equity markets, but they will not arrest a recession very quickly. In fact, If consumers and businesses know that interest rates and maybe prices are coming down, what will they do? They will wait. Now, the market in its wisdom, we believe, is already understands much of what I have told you. And so we do think that lower interest rates, when this carry trade is completely unwound, that lower interest rates are going to be the defining factor in terms of a rotation in the market away from a very concentrated group of stocks to a much broader based group of stocks. And as I just mentioned, innovation solves problems. So productivity gains are certainly what we believe.
All right, here's the issue about what she's just describing there. Okay, so basically she's trying to lay out a situation where we actually have a big recession, right? Unemployment goes up significantly, which she mentions, right? And you have the stock market actually do bad, right? Let's say all that plays out. How long does something like that take to play out? That could take a year, 2 years, 3 years to play out before you get the bottoming of that cycle, and then this true broadening of the market to happen. So what you just laid out there, that wouldn't be good for ARK funds over the next 1 to 3 years, just to be quite frank. That might be good years from now, but honestly, you'd probably be better off still avoiding that and going other places with your money, right? So I'm just like I always, let me listen to the rest of this and I'll describe Cathie Wood.
It's going to happen as AI proliferates throughout the global economy. So we just wanted to give you some insights based on lots of years of experience.
Come on, Cathie Wood. I mean, I'll try to be as nice as possible. Here's the deal with Cathie Wood, okay? I have a tremendous amount of respect for her when she talks about macroeconomics. I think she's very wise when it comes to macroeconomics. There's a big difference between knowing macroeconomics really well and running a portfolio really well and running money very well. And I don't need to say anything. Like you can't have this sort of performance when the market's doing this. You can't. Like that's baffling. Like if she was like here and it was like, oh, okay, Nasdaq's up 11%, SP's up 12%, she's up 7%, it'd be like, okay, yeah, she's underperforming the market, but okay, we'd be able to kind of wave it off. But down nearly 18% on a 12% and 12, like come on, you can't do that. So but a lot of people still pay attention. I mean, there's 200,000 views on that, right? So. But anyways, next one up here, enough data of earnings point toward consumer slowing.
Very research and a CNBC contributor, and Rebecca Patterson, former chief investment strategist at Bridgewater Associates. Great to see you both. Adam, so we have a growth scare of some sort going on, a hedge fund panic of some description alongside of it.
Listen, everybody should look at their own portfolio right now. Are you down this year? If you are down this year, you got to really start to question some things. If your portfolio is negative this year, start to question some things. What are you doing wrong? Are you not diversified enough? Are you gambling money in the market? Do you not know what you're doing? There's no excuse to be down at this point in the year with the Nasdaq doing what it's done and the S&P 500. No reason at all. So you got to really look in the mirror and be like, what's going on here?
Rethink about the Fed and maybe AI-driven earnings. In your view, what's the market struggling with, and how much have we repriced appropriately?
I mean, thanks for having me. It's great to be with you guys.
Yeah.
And the tee-up was right. I mean, it's a very volatile week. I think people are confused. I think a lot of the bottom-up stock pickers, I know hedge fund guys, covered some shorts, just thinking, all right, I got an opportunity to get some stuff down. And I don't want to say they're, 2 feet in on the long ideas, but they're trying to kind of look at some of the long ideas to add. I really think it matters if it's a growth stock or a value stock. If it's a growth stock, I don't think the major themes have changed. I think you still believe in AI semiconductors. Now you get them 35% cheaper. So there's really quality names you can look at that maybe you were worried about, whether it's NVIDIA or Cadence or whatever your favorite chip maker. I think people are trying to figure out, is this the point that I get a bottom below 100 on NVIDIA and now I have a little bit of good risk reward into the earnings print at the end of the month. I think that makes sense. So the growth themes that are in place, I think people are looking to. I think the main learning lesson on the negative side is that there is no such thing as a value stock if the momentum's bad. If the stocks have behaved bad, on average, the market's telling you they're not going to be good when the economy slows. So like, is Intel, do I want to buy the stuff that's really lagged? I don't think so, and so I think that's really the decision I'm making. And the other thing I'd just say lastly is there's no question the consumer's slowing. You can't take a step back from the July earnings and say, hey, that was a head fake. That was a Japanese carry trade, or that was disparate. Like, that was not. That was whether it was Visa, restaurants, travel, auto, housing.
McDonald's had its first same-store sale drop in 4 years. It's not an anomaly.
Right. Hershey couldn't get the price. There's just enough data points across.
I mean, to be fair, it's certain companies are doing well in this environment. I mean, for instance, did you see Honest earnings? Honest earnings were very good. Like, it's incredible how much they've improved their numbers on a year-over-year basis. Their revenue was far ahead of their own expectations. Their revenue was far ahead of where analysts were at, right? Small cap company you think would be struggling in this environment. Planet's revenues are starting to go back up significantly now at this point in time. Look what Palantir's doing, right? 27% growth rate here recently, the best growth rate they've had in a long, long time at that company. Look at Shopify's growth. Did you see Shopify's numbers? So if you're positioned in the right stocks, certain companies are doing tremendous in the market, and then you got others that are definitely struggling, right? So, it depends. You got to know what you're doing in this game, man. And a lot of people, they're not really positioned right. They're not positioned in the right stocks.
The consumer spectrum will say, it's not imploding, but it's eroding.
They think just everything's bad, and it's like, dude, it's not everything's bad. Like, there's certain companies that, they're struggling, but there's certain other companies that things are honestly better than they've ever been for these companies right now. An
okay Uber print, I got, MasterCard was better than Visa, but there's enough in that data pool to say the consumer slowed. Yeah.
Rebecca, I'd love for you to put the yen carry trade and the sort of macro frictions that we were feeling this week into some kind of perspective. Is this an ongoing issue we're going to be contending with?
Well, I think this week was a good reminder that all investors need to care about currencies. Year to date, if you bought the Nikkei,
you don't need to carry. You don't need to care about currencies. No. You need to worry about investing in great companies that have very bright 3 to 5 year futures in front of them, regardless whether unemployment's 4%, 8%, whether inflation is 2% or 9%. Like, you need to be investing in good companies regardless.
If you hedged out the yen, you're up about 4.6% as a dollar-based investor. If you didn't, you're up about 0.5%. So it matters in that sense.
If you're more worried about what's going to potentially happen with currencies rather than listen to conference calls, you're lost in this game.
And of course, it matters when you have things like the yen. We had extreme positioning. The short positions in the yen were the biggest we'd seen in years, and extreme valuations. And so one slightly more hawkish than expected BOJ announcement, plus some of the worries about the U.S., because Japan is still very dependent on U.S. demand, that was enough to get that ball rolling. And we see that the global contagion was pretty severe. So I think it was a good reminder that, for all of us, whether we're bottom-up stock pickers or macro investors, currency has to be part of what you're keeping an eye on, especially when things get extreme. I think at this point,
macro investor is an easy way of saying you don't know what you're doing in the market.
You look at the big banks' FX desks to get an idea where we are.
That was a joke in case no one caught that, but it was being absolutely serious. It was a joke, but it was actually serious. Like, if you're a macro investor that tells me you don't know what you're doing.
And I'll just go to my alma mater, JP Morgan. They're saying maybe 75% of the short positions have been unwound at this point. So there's room. We could still see some more. So I don't know if we're out of the woods on this, but we probably are pretty far down the track in terms of getting to a cleaner market position.
Adam, you mentioned that you think the worst case outcome for over the coming weeks is data that continues to show sticky inflation, and we'll get some more data on that next week, but slowing growth.
Yeah.
That combination has been really negative on sentiment in the past.
Right.
You still feel that's the thing that we need to be most concerned about in the coming week?
I think there was a minute last week where I thought bad news was bad and good news was good, that we got into that sort of normal scenario again. You described stagflation, right? And in that scenario, I can't find any historical example where the stock market acts well.
Yeah.
So I think you're right that would kind of tilt people to the negative. I'm not really sure that's the base case, and that I positioned for it. Look, it's funny. I did this risk dinner with 10 folks on the buy side in the middle of this week, and 0 people said that they had anything about the Japanese carry trade as a risk until they heard about it ex post.
Yeah.
Right. So I think the challenge on Rebecca's comment on currency is like we sort of know we're supposed to pay attention.
That's black swan right there. I mean, things come out of nowhere and shake things up real quick, right? And people never saw it coming until it happens, and then all of a sudden everybody's talking about, whoa, what happened?
But we just don't know when. I search every earnings call transcript for every mention of the yen, and there really weren't many. In the last quarter, there was one. It was Aflac, because they have a big Japanese business.
Yeah, sure.
There's like 12 this quarter, and the currency was massively moving all year, right? So it's just hard for the bottom-up stock picker guys to have a clue about when it matters, even though I listen to her and think, yeah, she's right, it's obvious. I feel like a moron that I wasn't, thinking about it.
Alrighty, next one up here. I have no confidence the unemployment rate will stay where it is.
As investors brace for a week of pivotal economic data, joining us on set for his take is Neil Dutta, partner and head of economic research at Renaissance Macro Research. So, Neil, they said it. Tom Lee saying the Fed needs to be less data dependent. Jeremy Siegel thinks the market knows better and should be listened to.
What are you talking about?
The Professor Jeremy Siegel.
But he did backtrack on those comments slightly later. But, I mean, where do you stand on where the economy is? What is demanding of the Fed right now?
I think the Fed needs to get on with cutting interest rates. I think they should do a large upfront move. If you look at their economic projections for 2025, Mike, they have the unemployment rate at 4.2%, and they have core inflation at 2.3%, and then they have the Fed funds rate at 4.1%. We're at 4.3% unemployment. Core inflation's been doing that 2.3 for the last 3 months, and the Fed funds rate's at 5.5%. So I think it's sort of like which of these is not like the other.
And you were saying this in advance of some of the July data. I wanted also.
If I was running the Fed, what would I do for the remainder of this year? I would do a 50 basis point cut September. I would do a 50 basis point cut probably December. Do a total of 100 basis points of cuts. That would give us, 4.25 to 4.5% going into 2025. And then we can kind of see how, late this year and then early next year, inflation adjust here. What's CPI kind of looking like in January, February? And then we can make judgments from there. If we want to keep cutting at like a 50 basis point rate, do we want to go down to 25, something like that? But that's what I would do. Do a 50 and a 50 for the remainder of this year, and then we'll see where the cards lay for next year.
So you're not saying because of what happened in markets over a few days?
No, I think the markets are a sideshow. I mean, why did the market sell off in the first place? I know people want to talk about the yen carry trade, but the big sell-off in the markets happened in the 2 days after the Fed met because the data was really weak. And we have a lot of data coming out next week, and if that's weak, I would anticipate, some pressure.
Do you agree with what Professor Siegel is saying? Conceptually, the Fed needs to start making forecasts, because there's a long line of people who would say, okay, maybe forecasts might be superior to data dependent, but how good are the Fed's forecasts? Not a great track record.
No, I agree with that. I mean, I think this isn't about forecasting. This is about just adjusting the policy rate to what we've already seen happen. The unemployment rate is up. It's been rising for 5 of the last 6 months, and core inflation's been coming in below expected for the last 2 months. And what's the Fed doing? Oh, we have time. We can wait. We just need a little bit more data. I mean, to me, it's a little bit ridiculous. So I do think they're kind of like holding on to this higher for longer a bit past the expiration date.
The counter to that, as you know, is, well, the unemployment rate is up because labor supply is up. The layoffs are not that worrisome. And so there's sort of a cushion, maybe structurally, tightness in the labor market. You know what I'm getting at.
Yeah,
even people say, hey, construction employment is actually up, and that's always been a better recession.
Immigration has resumed is another thing that you hear.
I think it's sort of like a little bit too much like PhD think. I mean, I look at the unemployment rate historically. It's a line that's either going up or down. It doesn't move sideways. If it's moving sideways for an extended period of time, it's because usually the Fed does something. Right. So and then if you think about the outlook, like what about the outlook gives anybody confidence that the unemployment rate will just stabilize here on its own. I mean, housing is slowing. If you look at new home sales that haven't been started, that's down over 35% against last year. That's going to weigh on construction. You're not going to get the kind of...
Yes, but in all due respect, sir, have you looked at some of these home builder numbers? Their orders are starting to fly back in here recently. So, we'll see. But I'm just telling you, like, the home builder, in terms of new sales, are starting to fly higher. So we could see a big acceleration in terms of home starts very, very soon.
Inventory investment boom that you saw in Q2. And incomes are slowing, which is going to weigh on consumer spending. So, yeah, I don't have any confidence that the unemployment rate will just stay where it is. Looking at layoffs, I mean, you're going to be waiting too long because that's usually the last thing to happen.
What do you think they're going to do at Jackson Hole in terms of rhetoric and messaging? Where are you placing your bets?
I think that they're going to basically do a little bit of a victory lap and say that the inflation issue has been resolved. And I think that, and that the balance of risks have changed, and that'll set them up to cut in September.
That's code for, we're going to try to get moving. Part of the big bullish case for risk assets, if you go back to the highs in July, I was saying this too, was the certainty that we were on a path for a soft landing and that the Fed was going to ease, but it was going to be able to do it deliberately for the right reasons because inflation was coming down, and slower easing cycles historically are more bullish for stocks than rapid ones when the Fed is kind of rushing to rescue the economy. Do you think they have room to sort of take it slow if they start in September?
I don't think that they should take it slow.
No.
It's not about I get the signaling. Like, I've seen people say, well, if they go only 25, that's bullish, and if they go 50, it's bearish. But it's really about the economic data. I mean, they're very, very restrictive. In my mind, by their own admission. So in my mind, that actually lowers the threshold for them to do a big upfront move. Because even after 50 basis points, you'd still be actually quite tight.
There's a political consideration. Donald Trump gave a press conference yesterday, and one of the things that we've been hearing from the Republicans is any kind of cutting activity between now and the election is basically a political gift to the Democrats. We know that Powell doesn't want to play that game, of course. But do you think that might temper the possibility of larger cuts or quicker cuts?
It's just ridiculous. Like, I'm just telling you guys, if the Fed cuts rates in September, it makes no difference in who's going to win the election. It's not like because the Federal Reserve cuts interest rates 25 or 50 basis points in September, people will say, oh, I got to vote for so-and-so now. That put me over. What? No. Like, come on, man.
Think they can look through it and just survive whatever
it's just an excuse. Like, it's just silliness
is in the wake of their move.
It's a great question.
I'm very good at this.
To borrow from Austin Goolsbee, I hope not. I think not. But I don't think it's going to matter one way or the other. I mean, you're sort of damned if you do, damned if you don't. So if they don't go and they do what they should do up front, then they'll have to do even more after the election, and that could look even worse.
Yeah, I mean, if it happens in September, they will have been on hold for 14 months, which is really long.
Exactly. If they have to do even more after the election, it would look way worse on the Fed, because then it looks like they're just making decisions based upon who's going to be in office. Because let's say T-Man wins the election, okay, and then all of a sudden the Fed just starts cutting rates left and right. That's going to look horrible. It's going to look like, oh, wow, yeah, you got your man's back, right? Because obviously T-Man was the one that put Powell in that position, right? So that's going to look horrible. Then let's say Harris wins the election, then people are going to say, oh, so Harris wins the election now, so you cut rates like crazy? Like, dude, no. That's why the Fed always has to make whatever decision they think is best and not do it out of politics, because then you just go down a rabbit hole and then it's going to end up looking even worse. So you cut in September, if somebody wants to say, oh, that's the difference in election, like they don't have a clue about how politics work or how voting works or anything like that. Just
if it would come out of the blue.
If they wanted to bail out the incumbent, they would have already eased.
Yeah, I mean, the idea that this election's going to hinge on 50 basis points is kind of wild anyway.
Yes.
I mean, the market didn't seem to focus much or react much to Trump's comments, which is kind of a reiteration of his stance that the president should have some kind of a say in Fed policy, monetary policy. Is there a genuine Fed independence question in play?
If
Trump were elected?
We'll let you know in November.
I don't think so. I mean, I think that, this is him being him. I think that,
All right, next one up here. The worst of selling pressures behind us, Tom Lee.
Welcome. It's good to see you.
Great to see you, Scott.
So I look at your notes today, and you suggest the worst is behind us. What makes you think that?
Well, I think the thing that we're watching is the VIX spike to 60 on Monday, which is the third highest reading ever, and the VIX futures curve inverted, which was the steepest inversion since the pre-pandemic times. Both are starting to normalize. I think the VIX, as it closes below 20, and it hasn't closed yet, and as that VIX futures term structure uninverts, that tells us the worst of the panic is behind us. I don't think it means we won't have ripple effects, because we know there's some trapped bulls, and there's still some nervousness around Iran and how much of this yen carry trade has to unwind. But I think the worst of the selling pressure is behind us.
How do we know that we had just a growth?
I mean, to be frank, I wouldn't expect Tom Lee to say anything different. I wouldn't, man. I would not expect him to say anything different.
Scare, and not something more dramatic to come, Tom. Never mind the unwind of the carry trade, and no one really knows whether that's over either. But when you think about those two events, what does it make you think about where we could go moving forward?
Well, I think investors, when it comes to the growth scare side, have something they can check every week, which is weekly jobless claims, because that's what was a positive surprise on Thursday, and a lot of it came from Texas. Texas had a big drop in weekly claims week over week. The fact that markets reacted so positively Thursday to that jobless claims number puts me in the camp that that's one of the big drivers, because we had a better than expected claims number and then the market popped. I think the growth scare is what's on investors' minds, and next Thursday they'll get another weekly claims number, and if that's also equally improving or stable, I think it's going to give people a lot more conviction.
What about the unwind of the carry trade? I mean, there's no real tell as to whether that's run its course, and that seems to be, the obvious catalyst at the beginning of the week for positioning being well offsides, and it just needed to correct itself. Has it finished?
Scott, that's a great question. Nobody knows how big that carry trade could be. I think there is a large insurance industry participation in that, and I did speak to some insurance executives this past week. As their view is, there's a lot of financial institutions that actually implemented this trade, but if it unwinds in an orderly way, it's not disruptive. It's just that if you have weeks or days like Monday or the last week, the end of last week, that's very disorderly, and that gets very expensive, because these insurance companies have to take off these hedges, and then they suddenly have unhedged carry trades.
Well, I just want to continue this. You suggest, if it unwinds in a messy way, there's no if. I mean, we saw at least the first reverberations from that unwind, and that was anything but orderly. What if there really is more of that to come, Tom?
Scott, there may be more of it. I think one thing that is been messy is the currency hedges, because these currency hedges were built for what you'd call like 1 percentile events, 99 percentile standard deviation. So a bigger move than that is what makes these hedges so expensive. They just let them expire. I think central banks can manage currencies within a 1 standard deviation band. So I think it's still important to watch currencies, but if we're staying in stable and predictable ranges, it can be a orderly unwind. But yeah, Scott, that's an uncertainty, just like the Middle East is an uncertainty as well. But markets climb a wall of worry.
Yeah. What do you make of how this week began? Not with necessarily the market upset, but So
let's say the market does sell off. What do you do in that sort of situation, right? Take advantage of great deals in the market. I mean, there's a long list of stocks that are having a lot of trouble. So here's my third quarter possible buys watch list. I mean, Celsius is looking juicy over this next few months as a buy. Estee Lauder's looking juicy for the next few months as a buy. Wynn Resorts, same exact thing, right? If you have any sort of longer term mindset, I mean, there's a lot of stocks that are great deals that will be money makers over the next 3 to 5 years, over the next 3 to 5 months. I'm not convinced of that, right? But over the next 3 to 5 years, there's just a long list of great opportunities. Keep in mind, this is just some of the best opportunities I find in the market right now. But keep in mind, this isn't even all the opportunities. There's more than this. There's more than this out there, folks. So, yeah, that's what you do. If we do have any more sell-off, people freak out over The carry trade.
Commentary around it, whether it was Jeremy Siegel of the Wharton School suggesting the Fed needs to come out and do...
Wait, are you talking about...
The Professor Jeremy Siegel.
75 basis point cut in an emergency way. Of course, he walked that back with our own Jeff Cox yesterday evening. Ron and Sana at the beginning of the week suggesting the Fed needs to come out and say something that essentially we've got your back from a liquidity standpoint. Do they need to do something before September's meeting?
Scott, I think both comments from both Ron and Jeremy Siegel are actually valid. But to me, what it speaks of is I think the markets and I think economists are no longer willing to deal with data dependence. I think they want a Fed that's more forward-looking because that makes them comfortable the Fed could respond if conditions deteriorate. I think that's the kind of language I'd like to see disappear is we're data dependent, so that by necessity they're going to be very late. I think it's actually encouraging to see this sort of pushback.
Yeah, that's fair. I wish I would have asked him about the small cap call, 50% this year, baby. I'm still waiting on that. Let's go, baby. All right, guys, appreciate you joining me as always. Thanks so much for being here. Thank you for being subscribed to the channel. If you're looking to apply, join my private group, become a much better investor. You can do so this week. That will be the pinned comment down there. Also get access to 1000xstocks.com, the best software out there for long-term stock market investors. Much love and have a great day.